Recording in progress.
So we'll take question SKYE page number 7.
Page number 107.
Page number 107. As it's a public limited company which has a functional currency of dollars, it has entered into a number of transactions in the year ended 31st May 2007. The directors require advice about how they should be accounted for. Sky has B shares in issue which allow the holders to request redemptions at specified dates and amounts. The legal chart of Sky states that the entity has a choice whether or not to accept the request for repayment of the B shares. There are no other conditions attached to the shares, and Sky has never refused to redeem any of the shares up to the current year, end of 31st May 2007. In all other respects, the instruments have the characteristics of equity. Sky also has preference shares in issue which are puttable by the holders at any time after 31st May 2007. Under the terms of the shares, Sky is only permitted to satisfy the obligations for the preference shares when it has sufficient distributable reserves. Local legislation is quite restrictive in defining the profits available for distribution. The directors of Sky wish to know if the above financial instruments should be classified as equity items or financial liabilities as at 31st May 2007. So there are two instruments given. B shares, an issue which allow the holders to request redemption at specified dates and amounts. At specified dates and amounts, the legal chart of Sky states that the entity has a choice whether or not to accept the request for repayment of the shares, of B shares. There are no other conditions attached to the shares, and Sky has never refused to redeem any of the shares up to the current year end 31st May 2007. In all other respects, the instruments have the characteristics of equity. What is it? It can be either equity or it has to be financial liability. What is it? Financial liability. Why?
So, redemption. Even the company is having the right to accept or not all the last period, we have accepted all the investment value.
Yes, Shamila, Chatura, Basit, what is it? It is financial liability or it has to be equity. Arya. Chatura says financial liability. Financial liability. Others? It is not a financial liability. It is an equity instrument. We'll explain the reasons. The reason is now where the redemption is at the discretion of the issuer, the issuer can decide whether to redeem or not to redeem. And the shareholders do not have any right whatsoever to demand their capital back. So the company can wait without redeeming the capital even until the company will be liquidated. So however much the shareholders shout So the company can wait without, and they can just turn their deaf ears and to wait without reacting. Let them shout as much as, let them shout enough. And we have the right, we have the right to wait without it. So the standard says you recognize something under equity if the entity has the unconditional right to avoid the cash payment. Does the entity have the unconditional right to avoid the cash payment? Yes or no? Yes. And also it continues to say that your past pattern of redeeming capital does not constitute an obligation to redeem capital in the future. Now it says they have the past practice. Whenever the shareholders insisted, the company has redeemed the capital. Whenever the shareholders have insisted, the company has redeemed capital. So the standard continues to say that your past practice of redeeming capital whenever the shareholders insisted does not constitute an obligation to redeem capital. Clear? So entity Sky has to recognize B shares under equity, not under financial liabilities. Need to dictate the answer. Okay. IS 32, presentation of financial instruments. Require an instrument to be recognized under financial liability, under equity, only if the entity has an unconditional right to avoid future cash payments. Future cash payments. Future cash payments. The past practice of redeeming shares does not itself constitute an obligation to redeem capital, does not constitute an obligation to redeem capital. The company has choice whether to accept the request of redemption or not. Accept the redemption or not. This concludes that the redemption is exclusively at the discretion of Sky and has an unconditional right to avoid cash payments. Avoid cash payments. Therefore, B shares should be recognized and presented in the financial statements as equity. As equity. The second one, the second instrument, Sky also has preference shares in issue which are puttable by the holders at any time after 31st May 2007. Under the terms of the share, Sky is only permitted to satisfy the obligations for the preference shares when it has sufficient distributable reserves. Local legislation is quite restrictive in defining the profit available for distribution. The directors of Sky wish to know if the above financial instruments should be classified as equity items of financial assets as of 31st May 2007. Is the question clear? It has to be financial liability. Why? The entity does not have unconditional right to avoid the cash payments if you recognize it under equity. Once the company starts having distributable profits, you become liable to reap it. So you cannot ever have a practice of you keeping it once under equity and then to transfer it to liability. You cannot keep moving, shifting it around. It has to be set and categorized at one particular place and keep it there once and for all. So therefore, since the entity does not have this unconditional right to avoid the future cash payments, it has to come under financial liabilities.
The basic specification, like when the reference shares, redeemable option is there.
Yes.
But when it comes to this profit, they satisfy the obligation to reference shares, then it's sufficient reserves to distribute. Like now, it's something like non-cumulative or something. Is there anything?
No, it is redeemable. Only thing, if you, for some reasons, if you start redeeming it at a time of the company not making profits and having enough liquidity, so that will result in company getting into another liquidity problems. Why you do not have profits and then you redeem capital. So there will be a hit in your equity. Okay. So now it has been decided favorably for both parties. Company will not be affected because the company has profits. The company doesn't mind redeeming the preference shares. And also the preference shareholders are collecting their capital back. So it's only just that, just for the purpose of postponing this repayment of capital, they have put up a small hurdle, they have put up a small barrier preventing the company from paying for that when there is a problem of liquidity, when there's a problem of profitability, the company will be prevented from redeeming, the company will be prevented from paying in cash for the redemption of preference shares at a time of the company not making profit. Not clear. So therefore, it's only just that you can delay it slightly. Just because you delay it does not mean that you can avoid. This year we don't have profits, but next year you can have profits. So you cannot be at losses continuously. Can you be at losses all along? No. So at one point in time, if you start making profits, immediately the preference share capital becomes payable. So you can keep it under equity only until the company makes profit. But for how long? You can't, guarantee. So once the company starts being profitable, it automatically comes under financial liability. I mean, you have to pay it. So the only thing is the company can postpone the repayment of capital, but the company cannot avoid exclusively the payment of capital. Clear? We'll take down the answer. The preference shares should be classified under financial liabilities. As the company does not have the conditional right to avoid the cash payments. The capital becomes immediately payable as the company starts making profit. As it becomes profitable, the company can keep delaying the payment and becomes liable for the redemption once the company starts making profits. Then second part, Sky has a foreign branch which has a functional currency of dollars. The branch taxable profits are determined in dinars. On 1st June 2006, the branch acquired a property for 6 million dinars. The property had an expected useful life of 12 years with a zero residual value. The asset is written off for tax purposes over 8 years. The tax rate in Sky's jurisdiction is 30% and the branch jurisdiction is 20%. The foreign branch uses the cost model for valuing its property and measures the tax base at the following rate at the reporting dates. Exchange rates, 1st June 2006, 5, 31st May 7, 6, the directors required by some as to the deferred tax implications of the above. Can I have a small answer? Okay. Right, we'll see. Now it's a combination of IS-21 plus IS-12. IS-12 is what? Taxation. S has a foreign branch which has a functional currency of dollars. The branch taxable profits are determined in dinars. On 1st June 6, the branch acquired a property for 6 million dinars. Cost of the property in dinars, 6 million. So this is translated. Now, what is it? If you have a branch, it is considered to be translating foreign currencies to functional currency or translating foreign operations into presentation currency. Operations into presentation currency. Operations into presentation currency. Okay. Functional currency of dollars. The branch taxable profits are determined in dinars. On 1st June 2006, the branch acquired a property for 6 million dinars. The property had an expected useful life. There is another issue. What is it? In the branch itself, there has to be a translation. So we need to determine not from the parent company, so head office perspective, you need to decide it from the branch perspective. So $6 million, and they have paid 6 million dinars. You need to convert that into dollars first. Okay, ne? Right. What is the initial translation? Initial translation has to be spot exchange rate. What is spot exchange rate? We bought it on 1st June 2006. 1st June 2006, $1 is equal to 5 dinars. So what is the dollar value? It is 6 million divided by 5. Okay, ne? 1.2 million. 1.2 million. Right. The property had an expected useful life of 12 years with a zero residual value. The asset is written off for tax purposes over 8 years. The tax rate in assessed jurisdiction is 30% and in branch jurisdiction is 20%. The foreign branch uses the cost model for valuing its property, plant, and equipment. Okay. So then,
What is gap?
So what date do they want us to do the calculation? Must be obviously by 31st May 2007. The director required advice to the deferred tax implication of the above. Okay, then we'll depreciate it. Depreciate, say, cumulative. Oh, wait. We depreciate or for tax purposes, we depreciate. The asset is written off for tax purposes over 8 years. And how do we depreciate for accounting purposes?
12 years.
12 years, no? Right. Cumulative depreciation. It has to be 1.2 million divided by 12. 100,000. So then accounting written down value. Accounting written down value should be this minus this and should be 1.1 million. Accounting written down value should be 1.1 million. Right. Now, do we need to retranslate the property again on the reporting date at the closing rate? Where are we? We are in the books of head office. We are in the books of the branch. So even though the functional currency of the branch has been dollars, we paid in dinars to acquire the property. So that is translating foreign currency transactions to functional, or that is translating foreign operations into presentation currency. Foreign currencies to functional. So initial translation should be at the spot exchange rate was done, and on the reporting date, another retranslation is or is not needed. That depends on whether this asset is a monetary, non-monetary asset. This is monetary or non-monetary. Property is non-monetary. Carry that cost. So you need not to retranslate it again at the closing rate. So the accounting written down value should be 1.1 and there's no any other implication. Then we'll calculate tax base. Tax base. Tax base. So what should be the tax base? Yeah, tax base has to be how much? Yeah. It is 1.2 million minus, yes, less cumulative tax written down value. Okay, how much? 150. This is divided by 8. 150 tax base. Tax base. 1.2 minus, it has to be 1,050,000. Then temporary difference. Temporary difference. $50,000. So what deferred tax do we recognize on this 50,000? It is at 20% or it is at 30%. Taxes are paid by the branch or the taxes are paid by the head office? Branch. So what is the tax rate in their jurisdiction? Foreign branch uses the cost model for valuing its property, and branch jurisdictions is 20%. So deferred tax 50,000 into 20%, 10,000. It's a deferred tax asset or deferred tax liability. Where the tax base of an asset is lower, the resultant deferred tax figure should be a deferred tax liability. So this is a taxable temporary difference. Taxable temporary difference. Okay, so deferred tax figure should be 10,000 deferred tax liability. Right. Now, you also need to discuss the deferred tax implications in The books of the head office or need not to? Need. What is it on? Yeah, that is on capital allowances difference and depreciations or some other difference. What is it?
30%.
Yeah, 30% should apply on what?
This translation, this we have done based on the branch operation.
Yeah.
Sorry, as a normal operation, now we are look at the translation of branch operation.
Okay, so I mean, they have not given anything other than property. So we need to assume that they have only that particular property in the branch operation. Now what do? You need to translate the foreign operations into the presentation currency. So what is the requirement? You need to translate assets liabilities at what rate? Closing rate. Are we given the closing rate? Yes. So then that difference is recognized into profit and loss or recognized into OCI. OCI. So on that OCI, if you recognize deferred tax, that deferred tax has to go to profit and loss or to OCI. OCI. Clear? Not clear then. Confusing then. Confusing.
7 months is too much.
I mean, they are giving marks more.
No, the 7 months they are given.
So what is not clear there? Now, what is the presentation currency? SKY uses which currency? Dollars. Now, the property is in which currency?
Is dinar.
Dinar. Okay. Right. Let's calculate it now. Asset on the acquisition date, 1st June 2006. 2006. Asset value is how much? We paid in dinars. SKY uses dollars. So what is the dollar value? Sorry, dinars, 6 million. 6 million. Dollar value has to be how much? 6 million divided by 5. 1.2. 1.2. And then asset as at 31st May. 31st May 2007. So what is the written down value in dinars? You need to take depreciation. 6 million divided by how many years? 12 years. 5.5. 5.5. That has to be translated at the closing rate. 5.5 divided by 6. Translation difference. Translation gain or translation loss? Yes. But there's a difference. What is the difference? $6 million was the original cost.
Yeah.
It was taken at the closing rate. Closing rate. Now, this previous difference of 283,333 is a combinations of two items. What are the two items? Combinations of two items. One is depreciation 100,000. So actual translation difference has to be how much? 183,333. Is it clear? Not clear then. We'll explain from the beginning then.
That is okay.
Okay.
And the translation was.
Yeah, we'll explain. Now, original cost was 6 million. So it was taken at the beginning, I mean, at the rate on the acquisition date of the asset, 1.2. So you need to depreciate the asset. It is over 12 years. So depreciation should be 500,000 in dinars, and it has to be 100,000 in dollars. Clearly? So then it has to be written down value is 5.5 million in dinars, and in dollars 1.1 million. Now what do? You need to translate this closing balance 1.1 million at the closing rate. Why? Because on the reporting date, all the assets and liabilities are translated to presentation currency at the closing rate. So once you translate that to the At the closing rate, what is the resultant figure? It is 916,660. So how did I take that figure? 5.5 million divided by what? 5.5 million divided by closing rate of 6. Okay, ne? So this total difference of 283,333 is comprising of two items. What are the two items? 100,000 depreciation and 183,333 is the translation difference. Translation difference. So basically here we need to work out on deferred tax on which value? 183,000. Clear then? Not clear then? We'll take down the answer. Deferred tax calculation in the books of the branch. In the books of the branch. Take down. The asset denominate the asset's value denominated in dinars dinars should be translated into dollars by applying spot exchange rate on the date of the purchase. Date of the purchase. The asset need not to be restated at the closing rate as it is a non-monetary asset carry that cost. Therefore, the asset is depreciated in dinars and is translated to dollars based on the historical rate. The differences between accounting depreciation and tax depreciation is a taxable temporary difference on which deferred tax liability of $10,000 should be recognized and measured at 20% tax rate based on tax jurisdiction. The branch is a foreign operation of Sky. And should be translated to the presentation currency, which is dollars. The assets are translated at the closing rate. There is a total difference between accounting written down value there's total difference of 333 in translating the foreign operation into the presentation currency, of which 100,000 is depreciation and the balance is translation difference of 183,333. Therefore, deferred tax asset on translation loss should be recognized and measured at 30% tax rate. 30% tax rate. I don't know how clear it was. If you want me to explain, we'll explain again.
The taxability in the Skybooks need to look at the 30%.
Yeah, because now from that foreign operations, there will be a translation loss, not a gain. Translation loss.
That gain, no? Not the initial translation.
No.
Difference that is, but the translation gain.
Yeah.
So translation loss.
Yeah. There's a question called Aaron, ARON. Did
Why no?
Yeah,
Yeah.
done. Did we do Hudson, HUDSON? March, June 2019.
HUDSON. No?
Yeah,
It.
did it. Uh, FISKERTON, I think we did it partly. Eh? Yes. Done, no? FISKERTON, 2018 December. And it was done. We'll go to cloud, CLOUD, cloud. Method. Year has not been mentioned. Just say cloud.
It is not a console, no?
It is part, there is a part from console also.
No.
Not the other. Then cherry. Partly under IFRS. Okay, we did not complete leases, ne? Tomorrow only we can complete.
Yeah.
It is partly from lease sale and this back will do it and we'll come back here.
Cherry.
Yeah.
There.
Here is there, ne? But without doing this, we can't go. Okay, then ANOUK.
Okay, yeah. That is section number 7. Page number 70.
Page number 7.
70.
7 to page number 70. Page number 70. ANOUK. ANOUK. Company A is a public limited entity with a reporting date of 31 December 2001. It has covenants attached to some of the bank loan balances included within the liabilities on its statements of financial position. The covenants create a legal obligations to repay the loans in full if ANOC's liabilities exceeded a specified level. A new financial controller was appointed in January 2002 and has discovered some financial reporting issues in relation to the year ended 31 December 2001. Receivables factoring. On 31 December 2001, company A sold some of its receivables to a debt factor. The factor advanced 20% of 40 million receivables sold. Further amounts become payable to ANOC, but are subject to an imputed interest charge, so that ANOC receives progressively less of the remaining balance the longer it takes the factor to recover the funds. The factor has full recourse to ANOC for a 6-month period, after which ANOC has no further obligations and has no rights to receive any further payment from the factor. The directors are concerned about the negative impact that any potential debt factoring arrangements may have on its loan covenants. As such, they have ordered the financial controller to treat the factoring arrangement in accordance with its legal form. B shares. One of A subsidiaries, company B, has 2 classes of shares, A and B. A shares carrying voting powers and B shares are issued to meet regulatory requirements. B shareholders agreement stipulates that the minority B shareholders can exercise a put option every 3 years, which require A to buy their shares. The exercise price is the original cost paid by the shareholders. In A's consolidated statements of financial positions, the B shares owned by minority shareholders are reported in equity as non-controlling interest. Cranes. On 31 December 2001, A signed a contract to use a crane for the next 5 years. The supply of the crane is permitted to substitute the crane for an alternative model during the period of use, and is required to do so if the crane develops a fault. Due to the size of the crane, the supplier would have to incur significant cost to substitute it. The contract states that ANOC can use the crane for any construction activities it wishes. However, the contract also states that the crane cannot be used if wind speeds exceed 14 meters per second. ANOC must pay a fixed monthly rental fee for use of the crane. ANOC has posted no accounting entries in respect to its contract. The financial controller found this contract by accident and suspects that the directors had attempted to conceal it. Discuss the accounting and ethical implications of the above. Okay, we'll just leave crane out for a moment. It has once again been given from IFRS 16. Can I just have a small answer for the first two, receivable factoring and B shares? Okay. Right. We'll see. First part of the question is given from which accounting standard? It is IFRS 9. IFRS 9, derecognition of financial assets. Derecognition. 31st December 2001, A sold some of its trade receivables to a debt factor. The factor advanced 20% of 40 million receivables sold. Further amounts become payable to A, but are subject to an imputed interest charge so that A receives progressively less of the remaining balance the longer it takes the factor to recover the funds. The factor has full recourse to A for 6 months period, after which A has no further obligations and has no rights to receive any further payments from the factor. So what do you mean by selling receivables with full recourse basis? Full recourse basis. Full recourse to A. Now the total carrying value of debtors is 40 million. And they have advanced only how much? 20%. That goes, say, 8 million. The balance 32 is receivable from the factoring company to A. Now, as and when the collections will be done in the future, only the balance part will be paid by the factoring company to A. So that depends on the payment pattern by the debtors. And within the 6 months period, it is at full recourse to A, meaning if the debtors do not pay, if there will be defaults, who will take up the risks? Who will bear up the loss? Factoring company will bear up the risks, or company has to bear up the risks? Company A. In other words, in this factoring process, company A has transferred significant risks and rewards to factoring company have not transferred. So without risks and rewards being transferred, financial assets can be derecognized or cannot be derecognized. Cannot be derecognized. So they need to continue to show debtors in the books, and the proceeds they collected should be recorded as what? Debit cash and credit pair. It is a loan. It's a loan, a liability. Okay? So that is the legality of the transaction. That is the substance of the transaction. Legally means what? Legally they have sold or they have not sold. Legally debtors have or have not been sold. Legally sold. But since risks and rewards have not been transferred, in substance in financial accounting and reporting, the sale is a complete sale, a genuine sale, or it's not a complete and a genuine sale. In substance, if you have not transferred risks and rewards, it's not a complete genuine sale and you cannot be recognized. So as per the substance of the agreement, financial asset debtors need or need not to be derecognized. As per the substance. If you derecognize, that is considered to be a sale. For there to be a sale, what is the necessity? For there to be a sale, what is the requirement? Risks and rewards would have been transferred. Have the risks and rewards been transferred?
No.
No. Then this is a complete and a genuine sale or not a complete and a genuine sale? That is the legality or that is the substance?
That is the substance.
That is the substance. So legally, what is it? Legally, we have transferred the legal title of debtors. So that's no longer our debtors and that becomes factor. Now, which accounting will favor company A in terms of their loan covenants? Recognizing the factoring process under substance or recognizing factoring process under legality? Legality. Why? If they recognize it based on legality, they can remove it from their books and they can, show profits and losses and there's no liabilities to be recognized.
There won't be an issue for the covenant.
Yeah, no issue for the covenant. So that is what they're asking. What is the question about? Discuss the accounting ethical implications of the above. Okay. What are the ethical implications there? So we have learned 5 ethical principles: integrity, objectivity, professional behavior, and professional competency and due care and confidentiality. Okay. There's another one. Integrity. So integrity means what? He has to be straightforward. He has to be fair in his all dealings. Now, the accountant, if he decides to recognize it under legality, he knows that what he does is wrong. He knows that he is not straightforward. He knows that he does it just for the sake of showing a better picture to the lenders. And he has not been straightforward. He is not fair in his all dealings. And then him being a professional accountant, qualified accountant in ACCA, will be required to follow all technical and non-technical standards. Now, IFRS 9 says, without you transferring risk and rewards, you cannot derecognize. Then if he recognizes despite of the requirement of the standard, it's like him disobeying and circumventing accounting standards and discrediting the profession. Clear? Need to dictate or can manage? Hard.
It will happen here, maybe sometime your battery smoke breaks and then will be used to connect the accounting standards and the.
But don't ever think that the students who were there in the previous class who go through have answered the questions properly.
That's the fact, no?
Yeah, they had the same kind of feedback.
Okay. They go through.
Yeah. So that was clear.
Yeah.
Then B shares. One of A subsidiaries V has two classes of shares, A and B. A shares carry voting powers and B shares are issued to meet regulatory requirements. V shareholder agreement stipulates that the minority B shareholders can exercise a put option every 3 years, which requires A to buy their shares. The exercise price is the original cost paid by the shareholders. In A's consolidated statement of financial positions, the B shares owned by minority shareholders are reported in equity as non-controlling interest.
This issue is the reporting, like your classification.
Yeah. What is it? Okay, we'll see. Now, which company has issued shares, Class A shares and Class B shares? Which company of the group? Yeah, that is subsidiary company. Okay. They carry voting powers. Shares A carry voting powers and B shares are issued to meet regulatory requirements. V shareholder agreement stipulates that the minority B shareholders can exercise a put option every 3 years, which require A to buy their shares. Now, this is which company once again? Yeah. V shareholder agreement stipulates that the minority B shareholders can exercise a put option every 3 years, which requires A to buy their shares. So which company should shares? V. What is V? Subsidiary company. When the shareholders, non-controlling shareholders, exercise the put option, the company is under the obligations to buy the shares and to repay capital, or is not under the obligation? Is under, which company is under the obligations to buy the shares and to repay capital? Parent company. Not subsidiary company. Okay. Right. So then, that is B shares. Subsidiary company showing B shares as equity is correct or wrong? Does subsidiary company have any obligations to pay for the shares? Pay for the shares when the shareholders exercise the put option? No. In other words, subsidiary company has unconditional right to avoid the cash payment. So there's nothing wrong in them recognizing it under equity. Every time when the shareholders of subsidiary company exercise the put option, which company is under the obligations to buy? Parent company is under the. Now, whether it is parent or subsidiary company, it is the group. So the group is under the obligations to buy shares and to pay for the shares every time when they exercise. So it's not under the obligation. Under the obligation. So now how should the consolidated balance sheet show the shares? It is equity or it is liability? Liability. Now how are they showing? How does the group show? Non-controlling. Non-controlling interest in the sense part of equity or part of liability?
Part of equity.
Part of equity. So their classification of is correct or wrong? Wrong. So they need to reclassify it from being equity under financial liability. Some questions are tricky.
Tricky.
Some are not easy.
Chartered also in the same kind of
Different style. Sometimes questions.
more calculated there.
Yeah, and also little lengthy. Little lengthy. These are tricky, no? They're not that tricky, but they are little lengthy.
These are one option like that. You can score someone if you get it correctly.
If you do the calculations proper,
Yeah.
there's a question, SITKA, June 2021. It must be under consolidation. Some there are console questions. Yeah. SITKA. Yeah. KA.
Question 37, page 82.
Question 37, page 82. Isha habe first time down mangara kiwar apa CMA kerupuk Isha kila.
Okay.
Have first time a lot of commitments have. Study karan barna habit. First time 42 wagi ave. Second time ek tama 53 katte. SITKA company is a software development company which operates in an industry where technologies change rapidly. Its customers use the cloud to access the software, and SITKA company generates revenue by charging customers for the software license and software updates. It has recently disposed of an interest in a subsidiary company M and purchased a controlling interest in billing company the year end of the company's 31st December 2007. Software contract and updates. On 1st January 7, S company agreed 4-year contract with Send company to provide access to license SITKA company software, including customer support, in the form of monthly updates to the software. The total contract price is $3 million for both licensing and the software and the monthly updates. SITKA company licenses the software on a standalone basis for between 1 million and 2 million over a 4-year period, and regularly sells the monthly updates separately for 2.5 million over the same period. The software can function on its own without the updates, although the monthly updates improve its effectiveness. They are not essential to its functionality. However, because of the rapidly changing technology in the industry, if Send company does not update the software regularly, the benefits of using the software would be significantly reduced. In the year to 31st December 2007, Send company has only updated the software on 2 occasions. Send company must access the software via the cloud and does not own the rights to the software. Okay, we'll first look at it and then come back to the other two. Discuss whether the 4-year software contract with Send is a single performance obligations in accordance with IFRS 15 revenue from contract with customers, including how the revenue from the contract would be accounted for in SITKA companies' financial statements for the end of 31 December 70. Your answer should include whether the revenue should be recognized at a point in time or over a period. We'll see whether we can, think of a small answer. What is it? Single performance obligations or two performance obligations? Single performance obligation. We'll see. If it is single performance obligation, how do we recognize revenue at one point in time or over a period? At one point in time. Why?
At the time you're passing the benefit you pass,
Okay.
the same time you consume the.
If it is so, it is at one point in time over a period. We'll discuss. On 1st January 7, S company agreed 4-year contract with Sen company to provide access to license to S company software, including customer support, in the form of monthly updates to the software. The total contract price is 3 million for both licensing the software and the monthly updates. S company licenses the software on a standalone basis for between 1 million and 2 million over a 4-year period, and regularly sells the monthly updates separately for 2.5 million over the same period. The software can function on its own without the updates. Although monthly updates improve its effectiveness, they are not essential to its functionality. However, because of the rapidly changing technology in the industry, if Sen company does not update the software regularly, the benefits of using the software would be significantly reduced. In the year to 31 December 7, Sen company has only updated the software on 2 occasions. Sen company must access the software via the cloud and does not own the right to the software. Okay. Now, they give the license to the software, and also they must give monthly updates. So even without the monthly updates, the software function or does not function. It functions, but there are problems. What are the problems? Although the monthly updates improve its effectiveness, they are not so essential to functionality. Okay. However, because of the rapidly changing technology in the industry, if Sen company does not update the software regularly, the benefits of using the software would be significantly reduced. So no point of using the software without the updates, and it is almost like wasting money for the software unless you take updates. So the updates seem to be quite significant to the entire arrangements. So without the arrangements, without the updates in the arrangements, the software is of no use. Why? The technology in the industry keeps changing so fast that they need to keep updated themselves. Okay. So as a result, even if the software can be used without the updates, for them to make the best out of the software, update seems to be core to the requirement. Update seems to be essential to the requirement, or does not seem to be essential. Essential. In other words, the customer does not benefit without the software. For the customer to be benefited, software updates will be a must. Software updates will be essential. Now, only the software updates will not be important if he does not have the original software. So both elements seem to be equally important. Now, say for an example, if someone is developing a software for fashion designs, for a business like say GFlock. They have developed the software and given. But at least once in 2 months' time, they need to keep updating the software for the new designs. Why? Especially for girls and females, they prefer to wear the same pattern or they do not prefer. So they buy the software and they will try to make benefits out of it, but without the regular updates for them to make new designs, that original software is of any use or is of no use. Is of no use. So for them to sustain in the market, for them to push their business to the future, and for them to compete with the other competitors, for them to keep pace with the changes of the technology and the other competitors, peer companies, please, future updates seems to be a must. Future update seems to be so essential. If not, the software will be of no use. So does the customer benefit only from the software without receiving the future updates? The customer is or is not benefited. Is not benefited. So these two, software and the updates, are what? They are kind of, interdependent and interrelated. So without the software, updates are of no use. And without the updates, the software is of no use. So as a result, these two items are not distinct within the context of the contract, so therefore should be combined into a single performance obligation. Should be combined into a single performance obligation. So how many performance obligations as a result? Only one performance obligation. Right. Now then how do we recognize revenue at one point in time or over a period? To realize, to conclude that the performance obligations are satisfied over a period, how many indications did we have? We had 3 indications. What were the 3? If the customer consumes the goods and the services as the assets and the services are created, then performance obligations are considered to be satisfied over a period. Or if the control of the asset passes to the customer immediately as the asset is created, once again the performance obligations are considered to be satisfied over a period. Or if the performances of the entity creates an asset which does not have an alternate use to the seller, and the seller keeps only the enforceable right to the payment, once again the performance obligations are considered to be satisfied at one point in time over a period. Here, which criteria can we use? Which one can we use? Which one can we use? Now say to a business like GFlock, software developer would have created and given it. In 2 months' time, another update has to be given. So from the new updates, they are innovating and they are creating new products, new models, new fashions, new designs. So that will keep being popular among the customers for another 2-3 months' time, and then another update has to be given. So that also will give, innovate new designs, new products, new styles. That also will start. That also will keep being popular for another 2-3 months. So likewise, every time when a new update will be given, that will be consumed by the customer instantaneously, simultaneously. It's not consumed by the customer simultaneously. Yeah. So as the services are provided, as the software is developed, as the updates are given, those updates are consumed by the customer instantaneously and simultaneously. So that's like you giving this update at one particular point in time and finishing it off, or you keep providing updates over 4-year period.
Keep providing update on
4-year period. Not clear. So it's not so easy. Why they have given points to either. Sometimes certain points are like 2 performance obligations. Sometimes it's like 1. Sometimes it's like completing performance obligations once and then finishing it off. Sometimes it's like so that's why it is harder, tricky. Clear, no?
explain this clear.
Okay.
Part is intangible.
Next one is intangible.
Part two
Part disposal.
discuss.
Okay, an intangible. Okay.
Part two, the same question.
Part B.
Describe and demonstrate how disposal of 1% of interest and the remaining interest 10% should be accounted for the separate financial statement of the same. And that is disposal.
Yes. Can we do that part? It's not console. Separate financial statements.
Yeah, you have to provide the answer like now we have a policy for 60%.
Yes.
Subsidiary. If they are separate financial statement, how you should consider the disposal.
It is not a disposal of a business, what that is simply disposal of what?
Yes.
Investment.
In your own accounts, you have equal part of your investment.
Yes.
That is where they should recognize the disposal gain on subsidy.
Yes, we'll see. Its company prepares separate financial statements in accordance with IS 27. Now, we have a IS 27. I'll just do a small. Did I explain IS 27 in theory class?
Yeah, now following trends. Then
I think we did not. No. Let me explain. It's not a lengthy one, very simple standard. Let me explain first and then come back here. Okay, right. Nothing to worry. Okay. Say company A has 80% equity shares in company B. Company A has exactly 50% equity shares in company C. Company A has 40% equity shares in company D. In company D. So what should company be for company A? A has 80% equity shares in company B. So what should company be for company?
subsidy.
Subsidiary company. And A has exactly 50% shares in company C. Balance 50 of company C would have been acquired by someone else. So what should company C be for company A?
A
Yeah,
subsidy.
a joint venture.
Okay.
Joint venture. Okay. And A has 40% shares in company D. So what is company D for company A? Associate company. For subsidiary companies, they need to consolidate and we apply line by line consolidation. Line by line. Okay, right. And even for joint ventures, you need to apply equity method. Equity method we used for associate companies are the equity method we should apply for joint ventures either. Equity method. Equity method. And for company D, that is an associate company, and A has to apply which method? Equity method. Now, these are the methods to be used for these three companies in the consolidated financial statements. Okay. So, company A is the parent because A has subsidiary companies, and then A has to prepare not only individual accounts, also group accounts, where P has to be recognized under line by line method consolidation, where company C has to be recognized under equity method, where company D has to be recognized also under equity method. Okay. But if company A prepares individual financial statements, individual accounts, individual financial statements, A need not to recognize company B on line by line basis. Need not. Okay. And A has 3 different accounting methods under which A can recognize company B, C, and D in their individual accounts, not in the consolidated financial statements. So what are these 3 methods? A can show investments in company B at cost. A can show investments in company B, C, and D under equity method. Under equity method. And A can recognize investments of company B and C under IFRS 9. IFRS 9, it can be fair value through fair value method. It can be fair value through profit and loss, or it can be fair value through OCI. Okay. But there are some small differences in recognizing some transactions. Okay, let me show you that. Just small differences. If it is cost, if it is equity, if it is IFRS 9, IFRS 9. Initial measurement of investments. Initial measurement of investment. It is at the cost. Equity method, cost. This is fair value. Okay. So if there will be a transaction cost in acquiring investment, transaction cost added to cost. Added to cost. Added to cost. Here added to carrying value. Oh, carrying value. Okay. Right. Then subsequent measurement. Subsequent measurement. There is no subsequent measurement here. Why? Having recognized them at cost, you continue to show them at cost. Okay. So no changes are needed. Equity method. What do we do? What do we do with equity method? Under equity method, investment is increased or decreased for subsequent equity changes. Equity changes. Here subsequent measurement is what? Fair value. Okay, not clear. Then here, dividend income recognition. Dividend income recognition. Profit and loss. Equity, this is as a recovery of investment and deducted from investment. This one to profit and loss. So that's it. If you have investments in subsidiary company, If you have investments in joint ventures, if you have investments in equity, you need to show either at cost or at equity or at IFRS 9. And these differences you need to remember. So that's it. There's nothing more than that. Okay, no? Right. It says company is prepare separate financial statements in accordance with IS 20. We explained this one, what is it? IS 20 or the CSID. I mean, they go on explaining these few principles right throughout the whole standard. Okay. At 31 December 2006, it held a 60% controlling equity interest in M and accounted for M company as a subsidiary company. In a separate financial statements, S company had elected to measure its investment in M using equity method. Correct? No? There's nothing wrong. On 1st July 2007, S company disposed of 45% of equity interest and M company for $10 million and lost control. At the date of disposal, the carried amount of M company in its separate financial statements was 12 million. After the partial disposal, S company does not have joint control of O, significant influence over M company, and its retained interest of 15% is to be treated as an investment in an equity instrument. At 1st July 2017, the fair value of the retained interest of 15% in M company was 3.5 million. S company wishes to recognize any profits or loss on the disposal of the 45% interest in other comprehensive income. Now, they can use either cost or equity, or IFRS 5, IFRS 9. Okay. They can use these three methods for the investments in subsidiary, associate, and joint. Now they have sold, out of 60%, they have sold 45%. 45%. Okay. Then what should we do? What is the carrying value of investments on the disposal date? Disposal date is 3rd December 2006. So what is the carrying value? 12 million. 12 million. So out of 12 million, how much are we selling? We are selling 45%. So what is 45% of 12 million? $5.4. So 5.4 is sold. At which price? What is the selling price? $10 million, no? 10 million. So by comparing 10 million and 5.2, no? 5.4. Okay, by comparing 10 million and 5.4, you can recognize profit. Profit on disposal. Okay. Now for this remaining 15%, does it make an associate company? No. Does it make a joint venture? No. Does it make a subsidiary company? No. Then can we make a choice from these three methods for the presentation of the balance? Now, in individual financial statements, we can use one of the three if it is an investment in a subsidiary company. If it is an investment in associate. If it is an investment in joint venture. Okay. Now the remaining percentage is how much? 15%. So does it become a subsidiary company? No. It does not become an associate even. It does not become an associate company. So then can we make a choice of these three methods for the accounting purpose, for the accounting part of the remaining 15%? Can or can't? Can't. Why? For you to make a choice of these three methods to do the accounting, it has to be an investment either in subsidiary or an investment in associate or an investment in joint venture. Now, this is not any of these three. So how do we recognize the balance? How do we recognize the balance in the individual financial statements? What should be the accounting? Now already they have been doing what? They have been using equity method. Can they continue equity method? Out of the three, they have used equity method. Can they continue the equity method? They cannot. Why? They can use equity method only if it is an investment in subsidiary. They can use equity method only if it is an investment in associate. They can use equity method in individual financial statements only if it is an investment in joint venture. Now, this is not any of these three. It is just an investment only with 15%. So how do we recognize? How do we recognize that in the individual financial statements date? Yes, fair value. Either fair value through profit and loss, if it is trading now, or you can make an irrevocable election to put it under fair value through OCI. Fair value through OCI. So you need to stop applying equity method, and then you need to transfer it to either fair value through profit and loss or fair value through OCI. Clear? So here you need to calculate the disposal profit or loss the way we did it, and then you must say that we need to discontinue using equity method. Before that, you need to explain this part. Yeah, I mean, you need not to say everything, you need to say that for this investment in associate, sorry, not for investment in subsidiary company, we can use one of these three. What are the three? Cost, equity, IFRS 9, but this company has made a choice. What is the choice? No, equity method. So with the disposal of 45%, only 15% will be retained. Then they need to stop using equity method and then to put it under either fair value through profit and loss or fair value through OCI and irrevocable election. And then disposal profit should be recognized by comparing 45%, 45% of investment sold with the selling price of 10 million. Clear? Not clear? Next part is from business combinations or from intangibles.
Discuss how two assets acquired in
IFRS 3 will do that on fair value, no? We'll do that on Wednesday, and we'll do that also. I mean, the question. Okay. There is a question DigiWire.
Section number 43, page number 91.
Question number 43, page number 91. Okay. DigiWire company has developed a new business model whereby it sells music licenses to other companies, which then deliver digital music to consumers. Revenue sale of 3-year license. DigiWire company has agreed to sell Music company, an unlisted technology startup company, a 3-year license to sell DigiWire company's catalog of classical music to the public. This catalog contains a large selection of classical music which DigiWire company will regularly update over the 3-year period. As payment for the 3-year license, Globe Music Company has issued shares to DigiWire company equivalent to a 7% shareholding. Voting rights are attached to these shares. DigiWire company received the shares in Globe Music Company on 1st January 6, which is the first day of the license term. DigiWire company will also receive a royalty of 5% of future sales of Globe Music Company as additional revenue for the license. On 1st January 6, Globe Music Company was valued at between 4 to 5 million by a professional valuer who used the market-based approach. The valuation was based on the share price of a controlling interest in a comparable listed company. Is it from IFRS 13? For the financial year end 31 December 2006, sales of the classical music were $1 million. At 31 December 2006, a further share valuation report had been produced by the same professional valuer, which indicated that Globe Music Company was valued in the region of 6 to 7 million. Investment in 4D company. DigiWire company has agreed to work with tech game company to develop a new music platform. On 31 December 2006, the companies created a new entity, 4D. With equal shareholdings and shares in profit, DigiWire company has contributed its own intellectual property in the form of employee expertise. Cryptocurrency with a carrying amount of 3 million, fair value of 4 million, and an office building with a carrying amount of 6 million, fair value of 10. The cryptocurrency has been recorded at cost in DigiWire company's financial statements. Tech game company has contributed the technology and marketing expertise. The board of 4D company will comprise directors appointed equally by DigiWire and tech game company. Decisions are made by a unanimous board. Pension plan. DigiWire company provides a defined benefit pension plan for its employees from 1st September 2006. DigiWire company decided to curtail the plan and to limit the number of participants. The monthly service cost calculated using assumptions at the start of the year is 9 million. The monthly service cost calculated using assumptions at 1st September 6 is 6 million. The relevant financial information relating to the plan is as follows. 1st January 630, 1st September 636 and 39, discount rate is given. Advise the directors of Digwire company on the recognitions and measurement of the Glow Music company shares received as revenue for the sale of the 3-year license and how they should be accounted for in the financial statements for the year 31st December 6 and royalty which Glow Music company has agreed to pay in respect of the 3-year license in the financial statements for the year 31st December 6. Your answer to A from a simple number 2 should demonstrate how recognition and measurement of the royalty is supported by the conceptual framework for financial reporting. Based on international financial reporting standards, advise directors on the following: the classifications of the investment which Digivire company has in 4D, the de-recognitions of assets exchange for the investment in 4D company, and any resulting gain loss on disposal of financial statements Digivire, whether the cryptocurrency should be classified as a financial asset or an intangible asset. Your answer should also briefly consider whether the fair value movements on the cryptocurrency should be recorded in profit or loss. Can we just see some answers for the first one, A? Okay. Right. What is the first question? Flow music companies are received as revenue for the sale of 3-year license and how they should be accounted for. Right. Before that, they should, before the valuations of revenue, tell me whether the revenue should be recognized by DigiWire as one single performance obligations or rather than, they should recognize revenue at one point in time over a period. Over the period. Why? Because performance obligations are satisfied over the period. Why over the period? Because subsequent updates are a significant part of the software updates, or it's not a significant part. It is a significant part. So without the future updates, like in the previous questions, without the future updates, the software is of no use. So as and when the updates are provided by the seller, software developer, the customer consumes or does not consume. Customer consumes. Customer consumes. Okay. Then we'll come to the revenue recognition. Now, who is the customer? DigiWire is the seller. Who is the customer? Flow Music. So DigiWire is receiving shares of Flow Music at the beginning of the contract or at the end of the contract or over the 3-year contract period. Over the 3-year contract period. So then they are receiving shares without you completing performance obligations. The value of the shares they receive from Flow Music can be recognized to revenue or cannot be recognized to revenue. Now it's like me collecting money from the customers without me selling the goods. You cannot. So then the value of shares we receive should not be taken into revenue, should be recognized into a contract liability initially, and it has to be taken to revenue over 3-year period. How do we measure it? How do we measure it? We should measure it at fair value of the goods we have sold or the fair value of the shares we are receiving. Fair value of the shares we are receiving. So it's like you debiting to a financial asset account. We are holding the shares of a company now. It has to be on one hand a financial asset. IFRS 9, on the other hand, what is it? Your revenue. Okay, right. Then, how do we measure the value of the shares on valuation of shares? On 1st January 16, Flow Music Company was valued between 4 to 5 million by a professional valuer who used a market-based approach. The valuation was based on the share price of a controlling interest in a comparable listed company. For the financial year end of 31 December 2006, sales of the classical music were 1 million at 31 December 2006. A further share valuation report had been produced by the same professional valuer, which indicated that Glow Music was valued in the region of 6 to 7 million. Now, Glow Music is a listed company, not a listed company.
Not listed. Unlisted.
Unlisted company. Okay, next. So now this valuer has given the shares of Glow Music based on which company? Based on a market-based approach. In the sense, market-based means what? They have taken the values based on another listed company. Another listed company. Why? Market-based. They have taken the market price of another similar listed company. So that is directly comparable to the share values of Glow Music, or is not directly comparable? Not. So what adjustments do we need to do to convert it to the market values of the shares of Glow Music? What adjustments? How many adjustments are needed? You need 2 adjustments. Why? Now, say for an example, we are trying to sell a vehicle which is highly marketable. And we try to decide the market value of a vehicle which is not highly marketable based on the market value of the vehicle which is highly demanded. So you take the market value of the vehicle which is highly demanded, that value should be increased or should be decreased by some percentage to arrive at the market value of less demanded vehicle. Not clear? Not. What I'm saying is now, we have 2 vehicles. One, not demanded, less marketable. The other one, high demanded, highly marketable. Both vehicles are the same, I mean. Make can be different, but features, year of manufacture, engine capacity. So you take the market value of the highly demanded vehicle. That value is used to calculate the market value of the less demanded vehicle. So the market value of high demanded vehicle should be decreased or should be increased by some amount to arrive at the market value of the less demanded vehicle. Decreased. In other words, the market value of high demanded vehicle should be discounted by a percentage to show, to demonstrate, to factor the effect of non-marketability. Okay, ne? So now this company valuer has taken the market value of Glow Music based on market prices of a listed company. That is marketable. The shares of Glow Music is not marketable. So that value is not directly comparable to the market values of Glow Music. What do we need to do? The market value that the valuer has taken should or should not be discounted. Not clear? Should be discounted to incorporate what? To factor non-marketability into the market price. Okay. What is the other one? Other one is, now they have taken the market value based on the controlling shareholders' market value or non-controlling shareholders' market value. Controlling shareholders. Now, Digiwire has received what percentage of shares from Glow Music? What percentage? 7%. Then Digiwire should be the controlling party or non-controlling party. So then again, the market price given by the valuer need to be further discounted or need not to be further discounted? Need to be further discounted to incorporate what effect? Controlling stake, non-controlling stakes. Now I am holding shares of commercial bank, say 60%. You are holding 40% of commercial bank. Both of us are holding the listed shares of the same company. But the shares I'm holding should be more expensive. Why? My shares have two things: what? Ownership plus control. And your shares have only what? Ownership. So for you to arrive the market value of your shares, the market value of my shares need to be discussed. Clear? Is it clear? Okay. Is it clear? Not clear. That appear pada ada karo. Ayo me pun dah kapo hopi kamu. Okay. Then part 2. Royalties which Glow Music company has agreed to pay in respect of the 3-year license. In the financial statements for the year ended 31 December 16, your answer to A2 should demonstrate how recognition and measurement of the royalties is supported by the conceptual framework for financial reporting. Ten marks. And we have a small answer. Hard. Hard. Hard.
Just given some information.
I mean, the questions are really good creative questions. But only thing is we have to have time. But I feel they are very flexible in marking.
I think so. Otherwise, like
No one can get through.
get through. So
Except for the people who practice and the teachers,
yes,
no one else can pass.
yes. I think if you have given some pose answer, they
Yeah. As it is, there are some keywords.
Yeah.
The keywords are there. You get marks.
Yeah. If you have correctly understood the correct standard, what should be applied?
Yeah.
The basic answer is there in the mass.
Normally, international passing rate is more than 50. Now, you can't believe the students like Maldives, even the Maldives students pass completely blank. Last time I did the seminar, completely blank. Our students far more better compared to them. I don't know how they pass. Still they pass.
Now, I think once you do your requirement, you need to practice like
You need to practice. You need to practice. If you have at least 200 hours of a session, if you can at least spend 200 hours within 6 months, we can do a comprehensive job, solid job. You become perfect in the subject, you can easily get through. If not, yeah. Now what happens is now people like you, now that those people can do, but they don't do that. When we have commitments, it's really. We'll explain. Eh? Okay, now there are two ways of paying. For which company? Digivai. What does Digivai sell? They sell Glow Music and unlisted technology startup company, a 3-year license to sell Digivai company's catalog of classical music. I don't know what product they sell, but it's some kind of a music. They are selling music, says a song. So at the beginning of 3-year period, they get these shares, but they can't bring it to revenue because they must bring it to revenue over how many years' time? Over 3-year period. So once they receive the shares, they must first bring it to, contract liability, and then over 3 years only they must recognize into revenue. Then apart from that, this Glow Music has also promised to give Digivai another payment based on future sales. Okay, ne? So Glow Music is selling the music of Digivai. It's like some artist singing a song to a CD or whatever. And good old days, people like Torana sells it. And Torana, I don't think they are now existing.
No more.
Yeah, no. So Torana will make a royalty payment to the artist based on the sale of the CD. It is called what? Royalty income. Okay, clear? Now, how should they recognize royalty income? Without they receiving royalty, without they knowing what royalty they are entitled to, they can recognize royalty income into revenue or cannot recognize? Cannot recognize. Now, they want us to relate it to recognition criteria in the conceptual framework. What does conceptual framework say? And that part I need to explain in detail. Conceptual framework says if you recognize elements in the financial statement, you need to look at 3 factors. You need to look at the definition of elements. If it is assets, look at the definitions of assets. If it is liabilities, look at the definitions of liability. Nothing which does not fit into the definitions can ever be recognized as liabilities. Okay, ne? Clear? Right. Now, then you need to look at relevant informations. Relevant informations. What does it mean? You can recognize element in the financial statements only if the recognition provides relevant information from the financial statements. Relevant information means you can provide relevant information from the recognition of elements if there is no uncertainty about the future cash flows of the asset or liability. Now, say for an example, you include debtors in the balance sheet. Why? Provide relevant information. Why? There is no uncertainty about the future cash inflow. I will take legal actions against you, claiming damages just for nothing. I'm asking 100 million rupees. I take you to courts. I'm asking compensations of 100 million for insulting me. You have done absolutely nothing. If I include that 100 million as a receivable, does that asset provide relevant information? No. Why? There's no certainty about the future cash inflow. Not clear. If you recognize an asset into the balance sheet without you having that certainty about the future cash inflow, then we do not provide what information? Relevant information. Okay. Then you must provide what? Faithful information, faithful representation. Faithful representation. There is no uncertainty about the future cash inflow, but the amount to be received is not sure. There's an uncertainty about the amount. I am claiming damages from someone. Okay, I myself do not know how much the amount should be. The courts have given that to another party. In the sense, there is a judges of 5, and 5 people have 5 different opinions. They must get the approval from another outside party. It has to be calculated by 10 scientists all over the world. And they must get the approval from NASA. Now, are we 100% sure as to what amount we will eventually receive? No. Without you having the certainty about final amount of the asset, if you include that into the balance sheet, we are not providing what information? Faithful representation. We are lying from the balance sheets. We are lying from the financial statements. I sat for the exam, grade 9 mathematics. I have to get marks from my school teacher. I know I will pass. But when the parents ask about the marks, I said 97. Is it faithful? Without being certain about the marks, I am now disclosing mark. I'm lying. So these are the 3 factors. Okay. Now, how do we relate it to DigiWire? DigiWire has received shares. You can include that into revenue or cannot include that into revenue. We cannot, but you can recognize the contract liability or cannot recognize. Contract liability can be recognized. At the same time, you can recognize financial asset. You can recognize asset. Why? It provides relevant information. It provides faithful representation. It satisfies the definitions of assets. Why? It is an asset. An economic resource arising from the past event, and the entity has the control over it. There's no uncertainty about the future cash inflow. And there's no uncertainty about the value. It was fair valued. But royalty income, without you knowing the actual sales value of claw music, if you include revenue, then does it provide faithful information, faithful representation? No, value is not certain. Value is not certain. There will be, violations of the requirements in the conceptual framework. We are not providing faithful representation. Not clear. That is a bit of a harder one because we have not done conceptual framework. So it's very difficult to answer that questions if you get a questions at the exam.
Is there linked to the conceptual framework?
No, ultimately everything is linked to conceptual framework, but how to know all of them. It's very difficult to know all of them. Okay. Part B. Based on international financial reporting standards, advise directors on the following. The classification for the investment which digivide a company as in 4D company. That we need to discuss on Wednesday. And IFRS 11 we did not do it. It doesn't take a long time. Within an hour we can finish IFRS 11. Only IFRS 13 will take little time, and also we need to do 38. Yes, investment property. We'll quickly run through. They are not harder standards. This question, one of the questions are very good questions, but
Discuss in detail. It's about the ratio and all that.
ratios were there sometimes back.
Maybe.
Yeah, now ratios, I mean, analysis part is not there. CALIBRA, September, December 2020. Was it done? No, no, not done.
Question number 23, page number 62.
Question number 23, page number 62. 23, question number, page number 62. Company C operates in the property sector and has invested in new technology, distributed ledgers, blockchain to trade and to support property transactions. The financial year end of C company is 31 December 2008. Company C builds apartment blocks which normally take 2 years to complete from the date of signing the contract. The performance obligation is satisfied at a point in time. The title and possessions and therefore control of the apartment blocks pass to the customer upon completion of construction. The price which is payable on completions of each apartment block is 9.55. Alternatively, customer can pay 8.5 million cash on the day that the contract is signed. The chief accountant has calculated that this represents an appropriate borrowing rate of 6% for C. C company immediately recognizes 8.5 million as revenue if customers pay when they sign the contract. Discuss how C company should have accounted for the sale of the apartment blocks in accordance with IFRS 15. Revenue from contract with customers and IS 23 borrowing cost. We'll forget about borrowing cost for the moment, will you? Now, Monday we are doing the class. So we can finish one standard Monday and Wednesday full day. And if you have time, we can do it from home. We'll log into the platform and we'll take at least one paper.
Okay.
And we'll try to answer it in the platform.
Okay. Yes, given the income should be recognized immediately over the period of time.
Now, what are they doing? They are constructing apartment blocks. So that takes normally 2 years to complete. 2 years to complete from the date of signing the contract. The performance obligations is satisfied at a point in time. So they first complete the constructions and then only they will deliver it to the customer. The title and possession and therefore control of the apartment blocks pass to the customer upon completion of construction. The price which is payable on completion of each apartment blocks is 9.55. Alternatively, customer can pay 8.5 million cash on the day that the contract is signed. Okay, now they have two options. What are the two options? Either customer can pay 8.5 million now and the customer can get the apartment blocks in 2 years' time. Or else the customer can wait over 2 years' time and pay for the apartment block at the time of receiving the physical possessions and the legal title. Then what should be the price? 9.55. 9.55. Now, if the company, shall I make a on off another? If the construction company receives 8.5 million right now, can they recognize that into revenue as soon as they collect the consideration from the customer? Cannot. Why? Performance obligations are satisfied in 2 years. So initially they should recognize it where? As a liability. And then they keep it in the liability over 2 years. And at which point should they recognize that into revenue?
Once they transfer that.
They transfer that to? Yeah, I mean, the construction company receive it now and they keep it in the liability until the construction will be complete. When that is given to the customer, then they bring it from the contract liability and put that into revenue. So that happens in how many years time from receiving the consideration?
2 years.
2 years. And in 2 years, at the time of your recognizing revenue, the value to be taken to revenue should be 8.5 million or different amount.
Different.
How much should it be?
9.5.
9.55. So you need to transform this 8.5 million present value into the future value of 9.55. So what seems to be the rate? Divided by 8.5. 9.55 divided by 8.5. So we'll take the square root. Square root. Gani. We'll take it from the calculator. It's must be easy about.
Yes, no?
Yeah, 9.5 divided by 8.5. The square root of this minus 1. Exactly the 6 point. Okay, so the question gives that 6%. So you need to increase it by 6%. Okay, right. Then, now this is your accounting. This is your accounting. You recognize 8.5 million. 8.5 million. So this is your contract liability. Contract liability, how much are we receiving? We are receiving 8.5. 8.5. And then you need to recognize interest for the first year. How much? 8.5 into 6%. 8.5 into 6% is 0.51. 0.51. Take the total. This plus this. The balance at the end of the first year should be 9.0. Then we'll recognize 9.01 into 6%. How much? 0.54. 0.54. So what is your total revenue then? $9.55. Do we get that answer? Yes, 9.55 comes. Okay, right. So then when the construction will be given to the customer, when the asset is given to the customer, then you de-recognize contract liability and then you recognize that into revenue. So this 0.54 and 0.51 should be recognized into what? Finance charge. Finance charge. And can we recognize that into the cost of the asset? Yes. Is it a qualifying asset? What is it like now? You collecting money from the customer in advance, it's like you receiving a loan. And that loan is for what? to construct the asset. Okay. So now as a result, this interest cost is incurred on what? Is incurred on qualifying asset. So can we capitalize that to the asset? Yes, we can capitalize. We can capitalize. Clear, no? Actually, those questions are good. I wish we have more time to discuss more questions. If we can, start the revisions at least for 2 months.
Then you would have gone through the one phase, and when with the theory, you can go through another phase.
Yes.
Repeat at the same kind of ones? No.
They are not repeating the same questions, but the structure is the same. Then shall we meet up tomorrow?
Okay.
Tomorrow we'll finish 16. Also, we'll do the question from the revision 8.
The number of dash to can I questions speed 1.75 වගේ දාලා නැත්නම් රයිට් මදි
වෙලා මදි ඕන් ඩොලර් ක්ලෝ කරන්න පුළුවන් නේ
ඔව් ඊට පස්සේ දැන් කැලේට පොඩ තේරුණා තමයි ගාලා ඒක